A lackluster recovery in China's economy is prompting investors to change their strategies. Not only are foreign investors pulling out more money from China's stock market, flocking to other major Asian markets instead, but shareholders of Chinese listed companies are also cashing in by reducing their holdings. Moreover, China's A-share market is witnessing its largest wave of delisting in history. Multiple indicators suggest that the Chinese stock market has entered a bear market. On June 6, China's main A-share index fell sharply again following a decline the previous day. The Shanghai Composite Index fell by 1.15%, dropping below the 3,200-point mark, hitting its lowest level since January 13th. 90% of stocks declined that day, with industries like electronics, semiconductors, power, military, and sensors suffering the most, led by a drop in Apple concept stocks. Luxshare Precision, a key Apple concept stock, fell by 7.34%, GoerTek Inc. by 6.85%, and Shenzhen Everwin Precision Technology by a staggering 18.92%. Meanwhile, foreign capital continued to withdraw. On January 6, foreign investors sold off 1.08 billion yuan, or approximately $151 million via the Shanghai-Hong Kong Stock Connect, a key cross-border channel between mainland China and Hong Kong stock exchanges. The Chinese stock market continued its declining trend from the previous month into June. The Shanghai Composite Index fell by 3.6% in May, recording its largest single-month drop in 7 months. In May, foreign investors accelerated their sell-off of Chinese stocks, which also led to a more than 20% drop from January's high for Chinese stocks traded in Hong Kong. On June 1st, Reuters reported that Refinitiv data showed foreign investors sold Chinese stocks worth $1.71 billion via the Shanghai-Hong Kong Stock Connect in May, far exceeding the $659 million in April. This marked a slow reversal of the significant foreign investment influx of $20.92 billion since January. It also suggests investors are becoming increasingly pessimistic about China's post-pandemic economic recovery. As the disappointment grows over China's stock market, other major Asian markets are becoming more attractive options for global investors. While China's stock market continues to decline, South Korea's Kospi Index has risen 20% from its low in September last year. Meanwhile, India's benchmark stock market index is nearing its historical high. Japan's stock market hit a 30-year high in early May, and Taiwan's stock market continues to outperform most global markets. Bloomberg pointed out that China's stock market performance is a stark contrast from other markets. Initially, there were concerns that the downturn of Asia's largest economy could drag down other regions, but other markets have still managed to surge. Japan's domestic recovery and ongoing corporate reforms, bolstered by support from business magnate Warren Buffett, have sparked interest in the country's undervalued stocks. The bright prospects for world-leading semiconductor manufacturers in South Korea and Taiwan are leading to a market rebound. A surge in demand for artificial intelligence is expected to bring a turning point in the semiconductor cycle. The benchmark indices of these two markets have also risen by at least 15% this year. In India, robust domestic consumption, coupled with an influx of foreign capital, has brought the Nifty 50 index within 2% of its historical high. Data shows that by mid-May, overseas funds had flowed into Japan for 7 consecutive weeks. Moreover, South Korea and Taiwan have seen a net inflow of at least $9.2 billion each this year, reversing the capital outflow trend of 2022. In contrast, according to HSBC Holdings data, global fund allocation to China has fallen back to the levels of October last year. According to Morningstar, a prestigious U.S. investment research institution, U.S. funds focused solely on investing in China, Taiwan, and Hong Kong experienced an outflow of $1.15 billion from February to April, following a $2.5 billion influx in January. Alliance All China Equity WT reported a $138 million outflow in the week of May 25th, marking its largest weekly withdrawal since July 2018. The iShare MSCI Emerging Markets Index Fund faced a net sell-off of $104 million. The New York Times reported on June 5th that investors continued to sell off Chinese stocks. Online retailer JD.com and hot pot chain Haidilao have suffered the worst, with average declines exceeding 20% this year. This has led to the Hang Seng China Enterprises Index, which tracks Chinese companies listed in Hong Kong, to drop to its lowest point of the year on June 1st. The CSI 300 index, tracking the largest companies in Shanghai and Shenzhen, has fallen about 8% since its peak in January. The real estate industry continues to cause investor pain. The latest data shows that May sales of the 100 largest companies' real estate dropped by about 14% from the previous month. Profits of China's industrial enterprises continue to decline, with the profits of large-scale industrial enterprises nationwide falling by 20.6% from January to April this year. In addition, on May 31st, China's official Purchasing Managers Index, or PMI, for manufacturing in May was released, showing a further slide to 48.8% from 49.2% in April, marking 2 consecutive months below the threshold of 50%. At the same time, service activity in China slowed in May. These data underscore a cooling of demand and intensifying industrial deflation in the world's second-largest economy. The continued tumble of China's stock market has also been impacted by recent decisions from the nation's top leader, Xi Jinping, which have shaken market confidence. Restrictions have been placed on U.S. chip company Micron Technology, causing market concerns. The Chinese authorities have also cracked down on foreign consulting firms, causing panic among several foreign companies and investors and raising renewed questions about the viability of international companies doing business in China. Economists from Nomura Securities wrote in an analysis report last month that China's economic recovery has stalled, partly due to Beijing's inability to boost confidence among consumers and corporate investors. An increasing lack of confidence in the Chinese market has led to rising unemployment, ongoing deflation, falling market interest rates, and a weakening exchange rate. Moreover, the Federal Reserve's interest rate hike to counter inflationary pressures has made investors increasingly risk-averse, which has led to a capital outflow from China's stock market. Pessimism is pervasive. Analysts suggest that foreign funds are likely to continue reducing holdings of mainland stocks in June, something that hasn't happened since the sharp fall in October last year. Bloomberg points out that with China's population shrinking and industries maturing, plus the uncertainty of Chinese authorities' regulations, any large investment carries risks. Since 2020, stocks in Japan, India, and South Korea have more frequently outperformed Chinese stocks. Now, as the yield of the Chinese stock market declines, growth prospects deteriorate, and the RMB depreciates, investors are turning away from the stock market that was initially seen as a likely favorite this year. Apart from the withdrawal of foreign capital, shareholders of Chinese-listed companies have also begun a new round of intensive reduction. As of June 1st, about 1,100 listed companies have announced plans for reductions this year. Analysts believe that as China's economic environment continues to deteriorate, many wealthy people have become pessimistic about China's economic prospects, opting to cash out and withdraw their capital. The influence of political factors behind these actions cannot be ruled out. Chinese media outlet Yicai reported on June 2nd that in terms of industries, TMT, or technology, media, and telecommunications, biomedicine, and specialized equipment manufacturing are where the most announcements of stock reductions have been concentrated. This includes the previously booming semiconductor industry, where many listed company shareholders are currently reducing their holdings. Just on the evening of May 31st, nearly 20 companies, including the Cambridge Industry Group Shanghai Co. Ltd., China Wafer Level CSP Co. Ltd., and Dongguan Dingtong Precision Metal Co. Ltd., disclosed their plan to reduce holdings. Among the individual stocks announcing reduction plans, there are many star stocks from various industries, including the office software and service provider Kingsoft Office, with a market cap of hundreds of billions, photovoltaic smart energy solution provider Trina Solar, and long-standing Shenzhen beverage manufacturer Eastrock Beverage. Lu Yuanxing, a political and economic analyst who once served as a senior marketing executive in China, believes that the concentrated reduction in holdings by numerous companies in China involves two factors, economic and political. Economically, the pandemic control measures in recent years have severely impacted China's economic environment. At the same time, the overall political environment is not very stable, further exacerbating the deterioration of the economic environment. He pointed out that China's current authoritarian control measures are becoming increasingly severe. The market environment is very poor, and industries are generally depressed. Therefore, many wealthy people are pessimistic about China's economic prospects, choosing to cash out and withdraw capital. This phenomenon can trigger a ripple effect. When people see many others selling off and cashing in their holdings, it psychologically impacts them, and this effect is amplified, he said. Moreover, from a political perspective, for many years, the Jiang Zemin interest group, led by former CCP leaders Jiang Zemin and Zheng Qinghong, has been controlling China's economic lifeline. After Xi Jinping, the current general secretary of the CCP, took office and suppressed many companies, this provoked a backlash from Jiang's faction. The direct consequence of capital withdrawal is downward pressure on the stock market. With a large number of companies further cashing in and withdrawing capital, the outlook for China's stock market will become even more gloomy. This trend may continue to spread in the future, he said. That is, every rebound in the stock market or individual stock speculation and manipulation will be accompanied by some major shareholders selling off and cashing in. I think this will have a very negative impact on China's future economy because it directly affects people's confidence. Furthermore, this year the A-share market has witnessed the largest wave of delistings in history. From April 26 to May 13th, 43 mainboard listed companies issued delisting or termination of listing risk warnings, already surpassing the total number for the previous year. As of April 30th this year, the 2022 annual report season officially ended. A total of 234 A-share listed companies received non-standard opinions from auditing agencies, indicating significant misrepresentations or fraud in financial statements, or significant doubts about the company's ongoing viability. On December 31st, 2020, the Shanghai and Shenzhen stock exchanges officially released new delisting rules, making it easier and faster for companies to delist. This means that many companies that had already lost their viability and have poor asset quality, the so-called stubborn holdouts, could no longer stay on the A-share market. Data from Wind Financial Terminal shows that the number of forced delistings in the A-share market in 2021 and 2022 were 17 and 42, respectively. The number of companies delisted in the last 2 years account for 40% of all companies delisted from the A-share market in over 30 years. The number of A-share delistings this year is certain to set a new record. On June 6, Languang Development, once known as Sichuan's #1 real estate developer, was delisted from the Shanghai Stock Exchange, becoming the first real estate company to delist from the A-share market recently. Currently, several A-share real estate companies face the risk of delisting if their stock price falls below 1 yuan. This could lead to financially distressed Chinese real estate companies losing important financing channels. According to the regulations of China's stock exchanges, if a company's closing price stays below 1 yuan for 20 consecutive trading days, it will trigger a par value delisting condition. Once this occurs, there will be no delisting grace period. The company's listing will be terminated directly. If a forced delisting is triggered, the pressure to manage credit, financing, and inventory liquidation will multiply, possibly leading to a bankruptcy crisis. According to Bloomberg, Xia Yifeng, a real estate analyst at BOC International China, stated that as of June 1st, The closing prices of stocks of 10 Chinese developers had fallen below 1 yuan in recent trading days. On February 17, 2023, the China Securities Regulatory Commission also issued the rules related to the full implementation of the stock issuance registration system, marking the beginning of a new era of full registration system in China's capital market. After the implementation of the registration system, forced delistings will become more common. According to its publicity, the registration system will diversify the conditions for mainboard listing, opening the door for innovative companies and some long-term loss-making enterprises of national strategic significance, such as wafer and biomedicine enterprises. The CCP's implementation of the registration system is not for simple reasons. Its real purpose is to let so-called zombie companies delist, and then allow industries heavily supported by the CCP, such as wafers, semiconductors, and new energy, to raise capital through the capital market, or to let state-owned enterprises rely on the capital market to grow and strengthen, increase the value of state-owned assets, and find new sources of income apart from land sales revenue. However, for the vast majority of Chinese stock investors, the A-share market has been a draining machine. According to media reports, in 2022, the average loss per A-share investor reached 79,000 yuan. Now, with the onset of the A-share delisting wave, millions of small and medium-sized shareholders face a dire situation with no escape and the risk of losing their entire capital. With the full implementation of the registration system, successive waves of investors are unable to escape the fate of being harvested like chives.